All right, gentlemen, happy New Year. I hope that you're all well. It's been a while since we spoke the last time. Quite a lot of things happened in the meantime. I got COVID over the Christmas break, and it's been, quite challenging, I have to say. Definitely more than just a little flu, but we're getting there. But it's been. It fitted quite well to a demanding 2020, and we all look forward to the new year. It's a great pleasure having two great friends of us here on the advisory board call. First of all, our permanent member, Jim Ricketts. Jim, thanks for taking the time.
Thanks, Ronnie. Great to be with you and Mark.
Jim, you're currently in New Hampshire.
Correct.
And then we've got as a special guest, Willem Middelkoop, sitting in Switzerland after a long drive from the Netherlands. Willem, thanks for taking the time.
Yeah, thank you for the invitation. Great to be here with some friends. Yeah.
Perfect. Well, I think there's many different topics to talk about today. Obviously, Jim's new book, but then also a topic that got quite a lot of following recently. The term "the Great Reset" was used or perhaps copied or stolen by Klaus Schwab. And initially, you noticed this great book by Willem Middelkoop that he published a couple of years ago, and that included so many fantastic forecasts. But we'll also talk about the way how Willem invests with his fund, his discovery investment style. And of course, I'm sorry, it's not COVID anymore. It's just a normal cough. And yeah, so plenty of things to talk about. But first of all, I would like to introduce our special guest, Willem. Willem Middelkoop is a successful entrepreneur, investor, and publicist. At the end of 2008, he gave up his journalistic work as a market commentator for Dutch national TV and started the Commodity Discovery Fund. He also started Amsterdam Gold in the same year, a web shop for gold and silver bullion, which was sold to the listed Value 8 in 2011 after yearly sales grew to over 100 million euro. Willem is a member of the advisory board of the London-based Official Monetary and Financial Institutions Forum, OMFIF. He's also a founding shareholder of Startup Bootcamp Amsterdam, a business accelerator program. Besides this, he's the author of 8 books covering financial markets and the economy. At the end of 2013, he published The Big Reset, where he sold a total of over 150,000 books in 7 languages, including Arabic and Chinese. Willem lives with his wife and 2 sons, 17 and 20, in the Netherlands, and has a bachelor's degree in business administration. Willem, thank you very much for taking the time again. Just some housekeeping before we get started. Mark and I and the whole team at Incrementum had a terrific year, 2020. Our combination of digital and physical gold that includes an options overlay had a banner year last year, up more than 80%. Our inflation fund did extremely well. And it seems that now, as Mark called it before, the saure Gurkenzeit is over for us. So we truly look forward to 2021. We just published a special piece on inflation where we present our, I would say, medium to long-term view on the topic of inflation and stagflation, which asset classes suffer and which asset classes profit from rising inflation or stagflation. And we're also very, very busy, and will be launching a new fund already in the first quarter of this year. That's it basically from our side. So we all look forward to a busy, demanding, and successful year. And I would like to start with a question to our special guest, Willem. Willem, you've sent over this article that you wrote together with David Marsh, the chairman of OMFIF, and it basically says in the end, in the summary, in all three scenarios, pressure on the international system will rise along with worries about higher inflation and currency debasement. 5 years ago, OMFIF designated 2016 as the year of multi-currency system, a term that can be traced back to an article in the Financial Times in November 1979. In 2021, OMFIF will be placing still greater weight on the political fallout of currency competition. We face a bumpy ride. So, Willem, please explain what you regard in or what you think about this bumpy ride, and how gold, how perhaps Bitcoin and the US dollar, but also the renminbi fit into this picture.
Yeah, let me first start by explaining how this latest article, which was published by the OMFIF, and of which David Marsh, the chairman of the OMFIF, was the co-author, how this article was written. I contacted the OMFIF in around 2012. That was quite, I think, 2 years after they started, because I was doing research for a book which I wanted to name The Big Reset. And it was very hard to find honest, reliable information analysis on the growing tensions, especially between the West and the East, on the international monetary system. All insiders knew after the collapse of Lehman that this system, this dollar-based, this dollar-centered system, couldn't survive for another 40 years. So I was doing my research. Of course, I was highly influenced by the work of James Rickards. So his books were a great source of information. But of course, I needed much more. And at a certain point, I saw an article online about a research report written by the OMFIF, which I didn't know. You know, the OMFIF was not well known at that time. And that report was talking about the internationalization of the renminbi, of the multi-currency system, which was needed as a new phase for the international monetary system to succeed the dollar. And it was also talking about the role of gold and how China was accumulating gold. And I was shocked because this report came from London, from the city, and this was so honest, you know. It's so remarkable to find some real honest research. So I contacted them right away. And I was afraid that I couldn't receive the full report, as often happens when there's a very honest piece of research out there. It's only for the elite or the higher level, and it can't be shared. But they were very cooperative, and they sent it to me right away. And when I read the full report, I was even more impressed. And then I saw a note that they were planning to do a seminar in London. And the seminar was attended by 3 or 4 Chinese professors from the monetary experts. So I asked them if I could be present because it fitted the research of my book. And then I was invited, and I didn't have to pay anything. So it was a great experience. And then I met David Marsh, the chairman of OMFIF. And David Marsh, he's a Financial Times journalist. He has been a Financial Times journalist for decades. He was their main correspondent in Germany for 20 years. And he has this journalistic approach, this honest journalistic approach. And I think we bonded right away because of this mutual background. I've been a journalist for 20 years. So we joined the OMFIF. We became a sponsor as a fund. And David asked me to join the advisory board. And I started to write some opinion articles for the OMFIF. But when I wrote this last piece in December, I sent it to David to ask his advice. And then I learned that he had all kind of his own insights about the way the reset, the monetary reset. So when we talk about the big reset, we talk about the changes which are needed to bring the international monetary system to its next phase. And that's something else compared to the thesis of the Great Reset by the World Economic Forum, which is trying to solve all worldly problems, including climate change. And when David Marsh was making suggestions for this article, he had such valuable input that I asked him if he wanted to be the co-author. And this clearly shows what happened to me in the last 5-6 years. And I think James has the same experience. Calling something the big reset 6-7 years ago, you were a fringe alternative commentator or journalist or writer. And now in 2020, the whole reset thesis came on the main stage and everybody wants to be involved with it. So David Marsh, as the chairman of the OMVIV, he's the co-author. He decided to publish it, with a lot of fanfare yesterday in London. They're thinking about making a translation in Mandarin because he has a huge following in China as well. So sorry for this long introduction, but this helps explain how I see the reset, how it compares to the Great Reset, and how more and more elite insiders are embracing the concept now. And I'm very interested to learn Jim's take on this.
Well, Willem, first of all, your book is a landmark and a classic. It was timely. Actually, it was ahead of its time when it came out. But the best books get better with age in the sense that you read them 3 years, 4 years, 5 years after they were published, and you say, not only is this still fresh, but gee, I wish I'd read it 3 or 4 years ago. It's still a benchmark for understanding ways in which the international monetary system may evolve. But what, and you and I met some years ago in the Netherlands, a very pleasant conversation. It was it's always nice to meet folks in person when you can. I had a similar experience with, we talk about titles or starting a little controversy. My first book, Currency Wars. The title actually came from Guido Matenga, who at the time, this is 2010, he was the finance minister of Brazil. And at the time, the dollar was weakening very sharply. The dollar hit an all-time low in August 2011. And that was also the all-time high for gold at the time. Gold has passed that more recently in 2020. But at the time, August 2011, about $1,900 per ounce. That was the all-time high for gold. Not surprising. Although I always say gold doesn't change. The only thing that changes is the dollar price of gold. And so as the dollar was going down, gold was going up to $1,900. And Matenga said, this is a currency war. He said, you, the United States, are cheapening your dollar, helping your exports, hurting other people's exports. We're importing your deflation. And everyone said, shut up. They said, of course, it was a currency war. He was exactly right. But as you were describing with the city, when do you get honest research and honest commentary versus a bunch of elites, maybe talking among themselves at a dinner party in Davos, but otherwise not really being candid or honest with even other experts who are certainly the citizens of the world. So that was the title of the book. And I thought, well, of course it's currency war. I mean, I'd studied international economics in the 1970s back in the Bretton Woods days. I knew what currency wars were, and I wrote a lot of history about it. But it was the title was extremely controversial because it was something you weren't supposed to say. But one of the things I said in the book, I said, we're not always in a currency war, but when we are, they can last for 10 or 15 years. That's how long currency wars take to work out, because they basically don't work. It goes back and forth and back and forth. So here we are in 2021, 10 years after the book came out. And I always smile a little bit when I see a headline in the FT or Financial Times or whatever saying, there's a new currency war. And I said, no, it's the old currency war. It's the same currency war. We're still in it, because nothing has been resolved and it goes back and forth. So, so your book was well ahead of its time and stirred up a lot of controversy with its title, and rightly so. And I did have that same experience with the book Currency Wars. Now, as to where we are today, your book is The Big Reset, but there's a lot of talk today about the Great Reset. And I do a lot of public speaking. Of course, these days, it's virtual than in person, but I do a lot of Q&A. And I didn't write The Big Reset, and I'm not the head of Davos, but Klaus Schwab, who did write The Great Reset. But I get the question all the time. And people say, well, Jim, when is the reset coming? When is the reset coming? What do you think about the reset? And today I take a deep breath and I say, which one? Because Willem Middelkoop's reset has to do with a collapse of confidence in the monetary system. You're the author, so I don't want to tell you what you said, but people know. Collapse of confidence and a new monetary system emerging from that. But Klaus Schwab just wrote a book, literally in the past few months. It's called the COVID-19, The Great Reset. And I saw that, and I always say that the elites and the globalists and or other bad guys. We could be talking about terrorists for that matter, different people, but they always tell you what you're going to do, what they're going to do. So these people have a plan, but they actually tell you what the plan is. The problem is no one's listening, or they speak in such jargon that you have to be an expert to understand it. And if you figure it out, they deny it. So there are a lot of hurdles there, but they actually tell you what they're going to do. And Klaus Schwab's book, The Great Reset, is basically a playbook. I read it. It's as scary as any Stephen King novel you could ever encounter. But it goes step by step through what the plan. When I say the plan, I'm talking about the Davos crowd, the global elites, the monetary authorities that you mentioned, Willem. And but we have a politician in the United States. His name is Rahm Emanuel. He was the mayor of Chicago, but before that, he was chief of staff for President Obama in his first term. And of course, they took office in early 2009, in the middle of the 2008-2009 global financial crisis that happened at the end of the Bush administration. And here comes Obama to take over. And Emanuel very famously said, never let a good crisis go to waste. And what he meant, and it was actually profound in its own way, the elites always have a plan, multiple plans on multiple fronts in terms of public policy. And they write these plans and they put them on the shelf. They know at a certain time, it's not popular, it doesn't have political support, not really feasible, but they write the plan and put them on the shelf. And then they wait for a crisis. And the minute the crisis hits, everyone's frightened, says, oh, what do I do? What do I do? And they take these plans off the shelf and they roll them out. Here's the answer. And they use the fear and the uncertainty in the general population as a platform for pushing an otherwise unpopular plan in the guise of a solution. And it's also subject to what I call the progressive ratchet, which is the progressives don't always get their plans, but when they do, they never give them back. So you might go years, actually, sometimes years, with no progress in the progressive movement. But once they get something in, it's like a ratchet. You twist it, but you cannot twist it back. It locks in place. We saw this with the USA Patriot Act. After 9/11, Americans were frightened. When's the next attack coming? But the things in the Patriot Act, the United States Treasury, in terms of currency transaction reports, under the guise of anti-money laundering, et cetera, they had wanted to do those things for decades, but finally they had an excuse. Now, same thing today with another twist, which is that the globalist agenda, and let me just be clear what that is, and not to make it a mystery. It's global governance, global taxation, and global policy, global control. That's all it is. It's globalism with a capital G. And I always say, well, if you want a global solution, which they do, you need a global problem. Again, going back to Rahm Emanuel's dictum. So, for example, tax policy is usually thought of as an internal problem. The U.S. can have one tax policy, Ireland can have lower taxes, somebody else, Canada, can have higher taxes, but nobody thinks necessarily that you need a global tax regime. But if that's your goal, then you need a global problem. And the first global problem, and Willem, you correctly identified, was climate change, because climate change if there is such a thing. That's a separate debate. But climate change does not respect borders. No one thinks that, you know, the climate in Canada stops in Canada and doesn't come to the United States. Of course it does. So climate change was their preferred horse to ride to a global solution. But two things happened. One, it wasn't getting much traction. Everyday people were kind of don't believe the scientists. I think they're probably mostly right about that. But Trump came along and reversed everything. He took the U.S. out of the Paris Accord. He took the U.S. out of multilateral trade deals. He took the U.S. out of the what we call the Joint Comprehensive Plan of Action with Iran. He withdrew from all these things and did an America First policy. So this was a setback for the globalists. So now two things have happened. They've happened literally in the past few months. Number one, the globalists have a new horse to ride. Of course, they still want the climate change, but they've got COVID. COVID is a panic. COVID causes fear. COVID is the perfect cover, if you will, for all kinds of heavy-handed regulation that Americans, and I think people elsewhere around the world, I'm rooting for the Italians. That you know, some Italian,
50,000 restaurants, I think.
Yeah, exactly.
Just open up. Yeah.
They say we're shutting down the restaurant, and all the people in the restaurant start singing freedom. You know, so they have the Braveheart mentality, which is great. So the Italians are standing up, but basically they're using COVID to pursue all kinds of policies that they would not otherwise be able to do, and they have not given up on the prior agenda, which is climate change. So Klaus Schwab, who is the founder and CEO, I guess if that's the right word, of the World Economic Forum, better known as Davos. They do a lot else all around the world, but Davos is their big show. It was coming next week, by the way. He's come out with a book called COVID-19, The Great Reset. So again, I'll just wrap up. When people say to me, Jim, when's the reset coming? I say, which one? Is it the Willem Middelkoop, you know, in effect, change, radical change, perhaps chaotic change in the international monetary system, which leads in one direction? Or is it the globalist agenda playbook led by Klaus Schwab, which leads in another direction? So they're both out there under the same banner, you know, big reset, great reset. Probably the confusion is intentional, not on your part, Willem, but on the part of Schwab. But they've kind of wrapped themselves in this reset blanket, and they're going full speed ahead. So I watch it carefully. I certainly recommend your book, but as a counterpoint, not one I agree with, but a counterpoint, read Klaus Schwab's book, because it's the playbook for the globalist hijacking of the world economy.
Thank you.
Wow, well, I think that was a great intro round. Well, I think we perhaps can take it from here to talk a little bit about William's Great Reset. Where are we doing? How are we doing on that front? I mean, so this multilateralism is probably the plan where we are heading in terms of monetary system. Perhaps we want to just have a focus on that. Willem, what do you see going on, I think 7 or 8 years later after you published your book?
Yeah, well, on the back cover of the Big Reset, so not the Great Reset, but the Big Reset, I mentioned, and that was 2013 when I wrote those words, that around 2020, we need to find a new face for the international monetary system. And there are two problems which need to be solved. And one of that is we need to find a new anchor for the world's monetary system. We need to find a successor for the dollar, and we need debt restructurings. And these were the main two parts of the thesis. And again, I'm highly indebted to Jim's work and his books, because this really influenced me. I only met Jim one time in person in the Netherlands. We only exchanged a few emails, but Jim is not aware how much he influenced my thinking. So I need to stress that again. But as I was writing in 2013 that we need the successor for the dollar, and that problem would become very timely around 2020, I questioned myself. You know, when you write a book, when you write a cover, the text for a back cover, there's always part is marketing, is promotion. So when you say around 2020, we need to find a new anchor for the world's monetary system, I sometimes doubted it myself because as we know, as experts of the monetary system, these changes take long, very long. The United States overtook the UK as largest economy in 1870. It took another 70 years before the US dollar became the world reserve currency. So I was questioning the 2020 myself. So when Mark Carney, the governor of the Bank of England, he's now retired, made this speech in the summer of 2019 in Jackson Hole, in which he said that the time had come to think about a new anchor for world's monetary system as a successor for the dollar. I was on holiday in the US and I was shocked to read it. This was 2019 and we had one of the most senior central bankers of the world at Jackson Hole, which is the annual party of all Fed economists, telling the Americans that they needed that we needed to find a successor for the dollar. You know, that was it for me, because how can you still want to discuss the thesis of the big reset after Mark Carney made this speech? So the only question we have now, and I talk a lot about this during interviews and during webinars, is how will the successor of the dollar look like? What will be the successor for the dollar? What will be the new anchor for the international monetary system? We all know it won't be the euro. We all know it won't be the renminbi. Jim has written books about this topic as well. And now we begin to understand that the central bankers, the central planners, are working on digital currencies. So there will be a digital euro within the next few years. We had the Digital Dollar Act in the US. The US is moving fast with a new digital dollar. Of course, we know China is a first mover with its digital renminbi. And I think the plan is, if you reread the speech by Mark Carney, his Jackson Hole lunch speech, which was of course no surprise for the Federal Reserve. There must have been some kind of dialogue about the content of his speech. And if you reread his speech, it's a very important speech, because as Jim said, when central bankers talk about this, they always talk in jargon. They always put on all this smoke and mirror. And if you read his speech with the current understanding of the different developments in central bank digital currencies, it's quite clear what Mark Carney's vision was already in 2019. He envisions a new world currencies, which is actually a basket of all the new central bank digital currencies brought together, probably within the IMF, as a new SDR, a new form of an SDR. Of course, the SDR was the solution first mentioned by Jim in his books, but the US was very opposed to the idea of using the SDR. So they had to invent a new idea. And that's why they came up with a basket of central bank digital currencies. And I'm of the opinion that they want to make a new world digital currency, and that will be gradually the successor for the dollar. That's my understanding so far now.
Yeah, thanks, Willem. Sorry, Mark.
Fascinating. Thanks. I think it's probably appropriate to hand over to Jim once more, because he did write a lot about that. Also, currency wars. It's, I think, still my personal favorite book of yours, Jim. So how do you think this is going to play out? This is kind of a little bit the Bancor version, just as a digital version. I don't know. 80 years later, I guess, 85 years later, something like that, right?
And people forget, and the yeah, the evidence in articles is out there. You have to dig a little bit. That in 1944, when John Maynard Keynes proposed the Bancor at the Bretton Woods Summit, which led to the creation of the IMF and the World Bank, and the predecessor of the World Trade Organization, really set the post-war architecture, which is held up in one form or another to today. Yes, the Bretton Woods gold-backed system collapsed in the mid 1970s, but the IMF is still around. Last time I looked, so all those institutions are still moving forward. But Keynes said that the Bancor should be backed by gold. Now, Keynes is quoted over and over and over as saying gold is a barbarous relic. He didn't actually say that. I went to great lengths to find a 1927 first edition of the book and looked up the quote. And he wasn't talking about gold. He was talking about the gold exchange standard of the 1920s. So he wasn't saying gold has no role. He was saying that they had a flawed architecture, which they did. So he was right about that. But he never said gold itself was a barbarous relic. But and Keynes was the leading advocate in 1914 at the outbreak of World War I, when His Majesty's Exchequer wanted to get rid of the gold standard because they needed to print money to fight the war. Keynes was the one who said, no, stay on gold, because if you do, your credit will be good and you'll be able to borrow as much as you want. But if you go off gold, you won't be able to borrow. He said borrowing is the key. That turned out to be true. Pierpont, it was Jack Morgan at the time, Pierpont's son, organized massive loans for the UK and France and nothing for Germany. And Germany lost. It's a complicated scenario, but Germany lost in part because they didn't have access to finance. So and then near the end of his life, I think he died in 1946. Maybe 47, I think 1946. But 1944, the Bancor was supposed to be backed by gold, and that gets glossed over and forgotten, but it is in his own papers now. So come forward to today. My wife hates for me to admit this, but I used to be a registered lobbyist in Washington. I ran a Washington office for an investment bank. I spent a lot of time on Capitol Hill. I was up meeting members of Congress, 2 or 3 days a week. And the first thing I learned in Washington is you can't beat something with nothing. In other words, if there's a system or a standard or a benchmark, whatever it might be, and you don't like it, you think it's unstable, you're against it, or even if you don't have a pro or con opinion, you just see it in effect falling in one way or another, you can't beat it unless you have something to replace it. So you can write op-eds, you can give speeches, you can yell and scream, you can call names, but unless you bring something to the table, that thing that you don't like is going to persist. And if you say, well, is the dollar system unstable? Yes. Is it on a non-sustainable path? Yes. Would a lot of people like to get rid of it? Yes. That's all true. And that's what Willem brought out in his book. But the fact remains, and it's a stubborn fact, that you can't beat something with nothing. So to predict the demise of the dollar, which is, every major reserve currency has collapsed sooner or later, going back for 5 centuries. You have to articulate the thing that will replace it. If you can't do that, then the dollar is just going to keep kind of rolling down the track. Now, in terms of replacements, a lot of people don't understand what reserve currencies are. They say, well, the dollar is a reserve currency, or the euro is a reserve currency, which it is, or the sterling is reserve currency, which it is, et cetera. But they keep talking about the currency, but it's not the currency. It's the bond market. You need something to invest in. The People's Bank of China has 1.4 trillion US dollars in effect in their reserve position, but they don't have pallets of $100 bills stacked up in the basement of the People's Bank of China. They own treasury bills, notes, and bonds. In other words, they earn the dollars, but they take those dollars and they buy government securities and hold them in portfolio. By the way, those securities are digital in a system controlled by the United States Treasury. So if we wanted to, in effect, freeze or confiscate China's $1.4 trillion, you could do it with a couple of keystrokes and a phone call from the president. So which, takes one back to the old joke, if I owe you $1 million, I have a problem. And if I owe you $1 billion, you have a problem because I might not pay you. And And we, the United States, owe China $1.4 trillion. So China has a problem, not the United States. So let me just pivot, hold that thought, but let me just pivot to Willem's notion about digital currencies. Initially, the digital currency itself, or what's called, they now call it as CBDCs, central bank digital currencies. So we're not talking about Bitcoin or Ethereum or all that stuff, and that's a separate subject. It need not detain us, but we're talking about fiat currencies, reserve currencies, central bank digital currencies. I would say the United States dollar has been the most successful cryptocurrency since 1980, because that was the last time the United States issued a paper treasury, where you used to be able to have a treasury bond or whatever you could put in your attic, and actually had little printed coupons on the bottom. You would tear a coupon off and go down to the bank and they would give you your money. They went digital right around 1980, 1979, 1980. So yeah, I could have a couple dollars in my wallet, so could anyone else. But the overwhelming majority of all the dollars, all the payments, all the message traffic, et cetera, is digital today. And all the message traffic is encrypted. So it's not like, I do wire transfers and the whole world can look. Maybe if you're a hacker, but not otherwise. The point being, central bank currencies are already digital currencies with encrypted message traffic, and therefore they are digital currencies, or cryptocurrencies, if you want to call it that. So what's new about central bank digital currencies? Well, it's moving side by side with another movement, which is, I would say, more important, which is the elimination of cash. In other words, you cannot, I always say, if you want to slaughter pigs, the first thing you have to herd them into a pen, get them all in one place, and then lead them to the slaughterhouse. If you want to slaughter sabers and citizens and freedom, you have to herd everybody into a digital pen, the digital holding area, so you can slaughter them economically. And but you have to eliminate cash, because as long as cash is an option, you can't have negative interest rates. If I have $100,000 in the bank and the interest rate is negative 1%, and I come back a year later, I only have $99,000. You took $1,000 out. You took 1% of my savings as a negative interest rate. Well, I have a simple solution for that, which is I'll go down to the bank, take out the $100,000, put it in a safe place. I come back a year later, I still have $100,000. So as long as cash is an option, you can't really impose negative interest rates. And the people favoring this, Ken Rogoff, professor at Harvard, and others, Larry Summers, and basically all the elites, people Willem is talking about, know this. So you have to have a 100% digital monetary system if you want negative interest rates, confiscation, account freezes, global taxations, and all the things that are described in Klaus Schwab's book. So, and who's the leader in that? Well, China right now. Willem's right about that. But China is doing it not just to be on the cutting edge of technology. I suppose they may be. They're doing a pilot program. But it's also a form of surveillance. So who has the most closed circuit TV cameras? Well, it's actually London, believe it or not, because that's a little bit of a legacy of the terror from the Irish Republican Army. But they kept building on that. But China is a close second, and China is a much bigger country. So they have cameras everywhere. They have digital, they have software for digital facial recognition. So they scan your face and they know who you are. They know your whereabouts. And then people started, with COVID, you wear a mask and sunglasses and a nice hat, can't scan your face. They have software that interprets your walk. Everyone kind of walks a little bit differently, so they can tell you that way. If you have a credit card, you're leaving a trail every time you use the credit card. They know who you are and where you are. You have your iPhone or Samsung or whatever other system is. The global GPS basically. So it tracks you. It's just like having a tracking device. So they know your whereabouts, they know your transactions, they know your habits, they know who you are, and they know what you're doing. Take that one step further, which is eliminate cash and make all transactions digital. So now you're a captive of the digital system they control, and the surveillance is complete. They know everything about you. So take that a step further and say, okay, now with the elimination of cash, and this is where China is moving very quickly in this direction, they'll be able to impose negative interest rates easily. You'll have nowhere to go. They'll be able to take money out for taxes, so they won't rely on you to pay your taxes. They'll just take the money. They'll freeze the accounts when they feel like it, just another form of monetary policy. Or if you're a political dissident, you're not with the program, or in the United States these days, if you just happen to be a Republican, they'll freeze your account. All of a sudden, you can't travel, you can't send your kids to school, et cetera. This is total social control. And if I'd said this 20 years ago, maybe I did, but the point is, it would have seemed like, George Orwell or Aldous Huxley, Brave New World. But saying it today, it's not even a forecast because it's happening. It's well documented. So now, just to kind of tie it into what Willem was saying, let's just take that a step further. If we've got central bank digital currency, CBDC, in all the major economies, so now including the United States, Europe, China, UK, Switzerland, et cetera, and they all kind of look the same. They're technically different. There are exchange rates, but there's no cash anymore. I mean, right now, tourists, euro is a bigger note than the US dollar. When I go to Europe, I have to get a different wallet out so the notes will fit in my wallet. And they're different colors. Europe has, I think, much prettier colors than the United States, et cetera. But people still have this intuitive sense that currencies are different. Even though the overwhelming majority of transactions are digital, we have just enough what we call walking around money to suggest that currencies are different. But what if all that went away? No more greenbacks, no more paper euros, no more yuan with pictures of Mao Zedong. It was all digital. It would all start to look alike. At that point, now back to Mark Carney, and Willem said he's retired. I always get worried when I hear that word, because when the leaders of the global monetary system retire, what it really means is that they've gone, now they're really in charge. So Mark Carney, he was the head of the Bank of England, but before that, he was the head of the Bank of Canada. And along the way, he was chairman of the Bank for International Settlements. So, you can't get a more elite central banker than Mark Carney. Even Ben Bernanke or Christine Lagarde have to sort of take second place to Carney. And Will was exactly right about what he said at Jackson Hole. But this proves my point, which is they always tell you what they're going to do. They kind of have to the extent there's any democracy left. But they use jargon. You have to be an expert. A lot of times I feel what I do, I'm sort of like a translator, if you will, because I have all the degrees and the expertise and the training and experience to understand exactly what Mark Carney's saying, but I can put it into plain English, which I do for a larger readership. But I feel like an anthropologist who goes into the elite jungle and comes out and reports on what's going on in the jungle. But if the euro, the dollar, and sterling, I'll say Swiss franc, and the yen, for example, are all the paper money goes away, and they're all digital, and the systems are all I'm trying to think of the word, interactive, but they're compatible with each other. It would be a very short step to world money, because you could probably get rid of exchange rates at that point and just agree on a fixed exchange rate. Or what you would really do, I think more likely, you would converge on the SDR. So you would say, okay, everything's in SDR. Now the number of dollars, per SDR may vary, or the number of yen per SDR may vary, but for purposes of generally accepted accounting principles, the financial statements of the 100 or so largest corporations in the world, government budgets, the European budget, et cetera, will do everything in SDRs. And if people want to cling to their old currencies, that's fine, but it won't matter much. So the central bank digital currency is a way station on the way from distinct national currencies to world money. But and by the way, this is an approach laid out by Karl Popper, who's the philosophical guide for George Soros, who is also still alive and well. He's retired, so that makes him even more scary. But it's incremental social change. In other words, they know the agenda is too radical. They know they can't do it all at once. So it's like a salami. Take a slice, another slice, another slice, another slice. And going back to the ratchet idea, none of it is ever given back. So, but this is a large step in the direction of exactly what Klaus Schwab is talking about, which is world money. So I do think it's a big deal, but it's not really a new euro or a new dollar, because those are already digital and already encrypted. It is a stepping stone to the merger of the euro, the dollar, the yen, and other currencies in a world money. And once that happens, so once you eliminate cash and conversion of world money, you have no autonomy, and you're completely subject to the dictates of the global financial elite.
And following up on CBDCs, and I think everybody should read the paper by the Bank for International Settlements that was basically put together by the Federal Reserve, the ECB, the Bank of Japan, the Swiss National Bank, and the Bank of England. It's fascinating, but also frightening. It would also, of course, basically destroy the traditional banking system, and it would kind of allow monetary authorities to set multiple interest rates, and that's what they are openly saying in this paper. But I think it's interesting to see that governments and central banks are kind of riding this wave and this momentum that cryptocurrencies, especially Bitcoin, have at the moment. And on the back of it, they are trying to create more momentum for their central bank digital currencies, which are obviously quite the opposite of what the inventors of Bitcoin probably had in mind. I would like to talk about the topic of Bitcoin now, Jim. We are having slightly different views, which is totally fine. But I would love to hear your views, Willem. So, what do you think about Bitcoin? Do you regard it as an enemy to gold, like many people in the gold industry see it? They say that Bitcoin is kind of stealing market cap and demand from gold, or do you see it as a cousin or a brother, or just as a competitor to gold? Where can we place you?
Yeah, I think my own journey has been quite long and maybe also interesting in this respect, because I come from the gold bug community. Because out of mistrust of fiat money, I'm a student of monetary history, and if you study monetary history, all fiat money systems have failed in the end. So this one will fail in the end as well, and central bankers and authorities are really speeding up that process, and that's why more and more people are turning towards gold and other hard assets now, and also towards crypto assets. And I first also had this idea that Bitcoin was competing with gold, and I was for that reason, I think, also a little negative on crypto, on Bitcoin, because there's no intrinsic value. And but after more thinking, I learned to understand that this is not a question if you should buy gold or Bitcoin. It's a question. The main question is, should you hold fiat or Bitcoin? Because both have no intrinsic value. While you could argue that Bitcoin has some form of intrinsic value because of all the energy was needed to create it. But let's, for the sake of this discussion, let's agree that both don't have any intrinsic value. If you look at the supply side, there's unlimited supply of fiat, and there will be in the future. But there's a very limited supply of Bitcoin, 21 million coins. So as the average Joe, if you need to choose between holding fiat and holding Bitcoin, more and more people will begin to understand that it's much smarter to hold Bitcoin. So I stepped away from the discussion, is it gold or Bitcoin? No, you should always have gold. That's the core of your, generational wealth, one could say, but you also hold cash. And I have my own investment model, which is 25% in real estate, 25% equity, 25% in physical gold and silver, and 25% in cash. And I've decided to put half of this cash. I started with just a quarter of the cash, but now I'll take half my cash and I'll store that in Bitcoin. And that has worked for me very well. And that solved my problem about how to value and how to see Bitcoin. And of course, I have this Dutch friend, you know him, Plan B. He's online. He's anonymous. Of course, I know his real name because I met him. He's a wonderful quant, still working in Plan A. He's still working for a Dutch institution. And he made this valuation model for Bitcoin, which turned out to be, well, the best we have so far. And so I think I came to the end of the journey, how to see and how to value Bitcoin. And I said that worked very well for me.
Wow, that's interesting. I never heard that you compare Bitcoin to fiat, but I can understand your thought process. So just throw this over shortly to Jim, because I know he put out a lot of content and his opinion regarding this. But Jim, do you think potentially a big portfolio, a diversified portfolio, there could be any argument to have at least, I don't know, a few percentage points in Bitcoin in there, or would you categorically say no to that question?
Well, people ask me all the time if I like Bitcoin. I say no, I prefer roulette because you can get a free drink and enjoy the evening. Here's the thing with Bitcoin: it proves that first of all, it's the 1980s technology. I mean, blockchain's been around for 40 years. There's nothing new about blockchain. It's very clunky. Willem is right that Bitcoin has arguably an intrinsic value because of the amount of electricity needed to do the computation. Gold, in theory, well, not in theory, but in fact has some intrinsic value because of the capital costs and other operating expenses of mining. But intrinsic value is irrelevant. It means nothing. If a gold miner spends $2,000 an ounce to mine gold and the market price of gold is $1,800 an ounce, so go broke. In other words, you can have an intrinsic value, but it doesn't mean anything. It's not what determines market value. Market value is completely separate. That was articulated by Carl Menger in 1879, kind of founder of the Austrian School of Economics, professor at the University of Vienna. So I don't know why people still talk about intrinsic value unless you're a miner, and then it matters. But intrinsic value has no bearing on market value. Market value is some combination of supply and demand, sentiment, other vectors, behavioral factors, geopolitical stress, et cetera. So I would start there. Number two, Bitcoin has a fatal flaw in terms of ever being a reserve currency. It won't be. I mean, first of all, I'd like someone to tell me where I can spend it. There used to be a coffee shop in Brooklyn where they took Bitcoin for a cup of coffee, but today everything in Brooklyn is boarded up because of the riots. So I'm not sure that's still around, but if someone can tell me where I can spend it, I know I can trade them all day long. I get that, but someone tell me where I can spend them, I might be a little more interested. But more to the point, Bitcoin has a fatal flaw, which proves that really good mathematicians do not understand monetary economics, which is the following. They limited the amount that can ever exist. And we're actually getting close to the limit. Now, we're not quite there yet. I believe round numbers, there are about 17.5 or 18 million Bitcoins, out there, not counting the ones that are, well, including the ones that are gone forever because somebody lost the password to their thumb drive. About 18 million, give or take. And the cap, again, I think it's about 21, 22 million. It's somewhere in there. But the way the math is designed, it takes more and more computing power, more and more electricity to mine each incremental Bitcoin. So there comes a time when you stop, basically. There's not enough electricity in the world, nor will you have access to it to mine one more Bitcoin. So we're getting close to that level. And so a lot of really smart people, lately it's attracted, the likes of Ray Dalio, Paul Jones, and others, very, very successful investors. So no argument there. Say, well, hold on. If you cap the number of Bitcoin, that was the idea, by the way, and Nakamoto, if whoever he or she was, or if it wasn't, Raytheon or Lockheed or somebody, said, we're going to cap it because we hate central bank. They keep printing money. They inflate the currency, et cetera. So we're going to solve the problem by capping it. But the economy is not capped, at least not yet. We're not in the new dark ages. The economy keeps growing. So if you have a fixed currency that cannot expand, a money supply that cannot expand, but the economy keeps growing, that is intrinsically deflationary. In other words, each Bitcoin buys you more and more stuff. It has to, because there's more stuff and no more Bitcoin. So each Bitcoin becomes more valuable in theory. And this is the logic behind smart people like Dalio and Paul Jones and others buying the Bitcoin. Say, well, it has to go up because that's how deflation works. The value of the money goes up, and you see projections of, I don't know, $300,000 or per Bitcoin. But why stop there? I mean, take it further down the road. But here's the problem, and it goes back to what I said earlier. The People's Bank of China does not have stacks of $100 bills in the basement. They invest in securities. They don't stack up the currency. So show me the Bitcoin bond market. It doesn't exist, and it will never exist. And here's why. Because who on earth would want to borrow in an inherently deflationary currency? It means you always lose. As a borrower, you always lose because you have to pay back in more valuable dollars. Lenders love deflation because it makes the value of the claim higher, but borrowers love inflation because it makes the value of the debt lower. And so now, ideally, there would be a balance there, and you'd have price stability. Good luck with that. But that's the basic dynamic. So as long as you have an inherently deflationary currency, which you do if you cap the amount and the economy keeps growing, you'll never have a single borrower, because nobody wants to borrow in a currency where what you have to pay back is more valuable than what you borrowed. Not counting interest, I'm just talking about the value of the money itself. And if you don't have a bond market, you can't have a reserve currency because they put reserves in bonds. So the whole thing falls down around the inability of whoever capped this out, Nakamoto, who capped out the quantity, to understand A, the inherently deflationary nature of it, and B, the fact that nobody will borrow in a deflationary currency, and C, if you don't have borrowers, you don't have a bond market, and therefore you don't have a reserve currency. So all these flaws will, not to mention the fact that if the power goes out, good luck finding your Bitcoin. So there's more to it, but that's the basic flaw in Bitcoin.
Could I give a short reaction on this, Mark?
Sure, you can. Let me just also interject a very few thoughts of mine here, because I think that's an interesting point. I'm happy to disagree here with you, Jim, but I think what you perhaps are arguing is basically the world in terms of a debt-based currency, like we have had since over 100 years. And I think it works differently in an asset-based currency. And I think also the example of late 19th century, we had basically a slightly deflationary monetary system, which was again asset-based. It was gold back then, and gold, I know it is not completely, there's no zero monetary inflation. It is slightly inflationary in terms of monetary inflation, but still, it was at the end of the day slightly deflationary in the sense that the economy grew faster than the money supply, right? So that's why prices actually went lower. And I think you're right. Or everybody, I think actually even probably Keynesians or even MMT people, for that matter, are right that if they want to perpetuate this debt-based system, we actually need this inflation. We need monetary inflation. We need price inflation. But I think this potential Bitcoin standard, or a gold standard for that matter, it doesn't matter. Asset-based currency system would turn this upside down. And I think you would actually then, as a reserve holder, don't need to hold bonds, because you wouldn't need to be able to necessarily collect interest payments because the asset itself is appreciating, and you don't need to compete in this rat race and try to keep your real value with some interest rate. So I think that the whole monetary system would flip, and I think a deflationary monetary system would actually be very possible. And we had some kind of examples already historically. Willem, sorry.
Yeah. Well, I agree with Jim that Bitcoin has more or less failed as a medium of exchange. I think we all can agree on that. I also agree with Jim that I don't see Bitcoin to become the new world reserve currency. You know, I can't envision that. You know, central bankers will never allow Bitcoin to be the new world reserve currency because they can't control it. So that's a no-go. But as you know, there's a third dimension of money and also digital money, and that's the store of value. And I think Bitcoin has proven to be a great success as a store of value. And that's where I think Bitcoin is very, very interesting. And that's what's attracting now more and more people with very deep pockets. If you look at the MicroStrategy case, these are not stupid people. These are not gamblers. You know, they have been thinking about it. If you listen to the interviews of the CEO of MicroStrategy, he's been comparing Bitcoin with gold, with everything. You know, he's gone through the same thought process. And he came to the same conclusion that if you need to store huge amounts of money and you don't want to buy only physical gold for whatever reasons, Bitcoin is very, very interesting. And if you see the average growth of value since inception, I think is 9% per month. So you only need to store a very few percent of your net worth in Bitcoin to make a difference. And I had another interesting idea last week or 2 weeks ago. I sent a tweet about this. I hope it's interesting. But could it be true that the incredible rise of Bitcoin with targets now of even 1 million or over 1 million, could it be that Bitcoin is the first proof of hyperinflation within the Western dollar-centered monetary system, which means like gold in the Weimar days, in the Weimar Republic, you know, the gold price could rise to billions and billions. There was no top for the price of gold. In a hyperinflation, there's no top for the price of gold. And I'm afraid that we see the same thing happening now with Bitcoin, because even today, as we speak, the demand from institutional investors is way larger than the daily production by all miners, Bitcoin miners. So I think it's a little scary, even this idea that the rise of Bitcoin could be unlimited.
I can destroy the Bitcoin market, or I'll say the value of Bitcoin, with one word: tether.
Oh yeah, that's the only risk I see.
Well, it's just like 12 years ago, I could have sat on the veranda at the Breakers Hotel in Palm Beach and been thrilled to learn that I had finally been invited to join Bernie Madoff's fund, which has a fabulous track record, just keeps going up and up and up. And I could look at my statements every month and see how much more money I made. And Bitcoin looks like the greatest Ponzi in the history of the world, because first of all, just a little, you guys know this, a little bit of hedge fund mark-to-market accounting. So I have a pool of Bitcoin, and there's a price per Bitcoin. You can look it up. So multiply the units by the price. There's your market, okay? But all it takes is one person buying one Bitcoin at the end of the day. There is no end of the day, but any point in time at a higher price, and the entire Bitcoin goes up. Well, try selling it. I try. If everyone tries to get that price, it'll go to zero very quickly. But it's very easy to manipulate. There's no SEC or securities regulator or FSB or whatever regulator you want. And there's no such thing for Bitcoin. And I'm not even talking about all the frauds and all the exchanges that have failed. And I'm not even talking about that. That's, it's out there, but that's not the core argument. But as I can paint the tape, I can mark up the whole market by, $500 billion just by doing a very small quantity at an incrementally larger price. So it's very easy to manipulate, number one. Number two, it is being manipulated. And I would encourage any Bitcoin fans to study Tether, what Tether claims, the fact that it's under investigation by the US Justice Department, and the dynamics between Tether and Bitcoin, because it looks like they're taking in hard dollars. I can walk out my door right now. There's a little store I live in a small town, a small city. It's a little store about a block away, and they sell Bitcoin. I could walk into that store. I know I can do it online, but I could walk into the store, chat with the person, hand them hard dollars, and get some Bitcoin. There go my hard dollars. Now, the point being, it's easy to manipulate. It's easy to paint the tape. It looks like that is happening because of Tether. It looks like the greatest Ponzi in the history of the world. It looks like it will come to a very bad end, and you can't spend it, and there's no bond market. Other than that, how was the play, Mrs. Lincoln?
I would say let's move over to our investment views. Jim, you obviously published a book quite recently. I think it's published in German today as well. The same publishing house like where we also published our books. And I just read a quick summary. It says that the title of the book is The New Great Depression, Winners and Losers in a Post-Pandemic World. And it says, the happy talk from Wall Street and the White House is an illusion. The worst is yet to come. But for knowledgeable investors, all hope is not lost. So can you pun intended, talk your book and let us know briefly to what conclusions you are coming in the book?
Of course. Please bear with me 30 seconds or 25 seconds. Be right back.
In the meantime, we can promote Willem's book, The Big Reset. I looked it up in my bookshelf. It's a fantastic book. Willem, may I ask, if we're always a bit, let's say, schizophrenic, talking about the future and trying to predict the big developments. Are you positively or negatively surprised by what's actually happening compared to when you first published the book?
Yeah, of course. When I wrote The Big Reset, I didn't know, like we all didn't know, that Corona would hit us in 2019, 2020. But now we know Corona is here. It's quite clear that Corona will be used as the catalyst for many of the changes which I felt coming and which I predicted for the next, let's say, decade. And it's so obvious that there's so much negative fallout out of this Corona crisis from an economic point of view, from a social point of view. If you want to put on your negative glasses, everything is at stake almost. People stop paying rent. In the Netherlands, where I live, huge chains of retail stores stopped paying rent. Think about that. When people stop paying rent, owning real estate is a great investment, is a great asset 98% of the time. But also, the beautiful buildings in Amsterdam, in the city center, along the canals, they're 400 years old. But the value of those buildings went down 70-80% during the French Revolution. So there are certain times that you don't want to own real estate. And I'm rather scared by everything going on now and the negative fallout. And we all hope that after this vaccine, we all can live happy again and everything will be normal again. But I think the damage done to the economy is too large already. And the elitists, the global planners, the government, the central bankers, they understand this. That's why Klaus Schwab, he said it, we have a small but closing window of opportunity to bring change, because you need change now. You can't go back to the old days. But I'm very interested to learn about Jim's ideas.
Ronnie, thank you for the introduction. I just had to get a copy of the book. You can see the cover. We have a nice dollar bill, and George Washington is wearing his surgical mask. It's called The New Great Depression, Winners and Losers in a Post-Pandemic World. And you're right, it is out in, we've sold rights in 14 languages. It is out in German. The Germans are so efficient, they actually got the German language edition out before the English edition, which is unusual for a foreign publisher, but Finanzbuch Verlag, they do a great job, and they got an early copy and got the translation done. I wrote a new forward for the German edition for the German audience. So I hope people enjoy it, but of course, out in English. And I'm glad to say that in the Amazon rankings, they have a lot of subcategories where if you take the audiobook, the Kindle, or the hardcover, one or the other, but we're number one in money and monetary policy. We're number one in wealth management, and we're number one in economic conditions. So all of our categories we're kind of leading the pack. We were ranked number one news release by Newsmax, and we just got a book review in the New York Times last Sunday. It's one thing to make the New York Times bestseller list. That's a big deal, but it's even more exclusive to get a book review, believe it or not, from the New York Times. So we got that. So the book is doing very well. Thank you. But it makes a couple of points. Number one, Willem said that we hope for a world where the pandemic is behind us and things can get back to normal. Well, we certainly hope for that world. It will not come as soon as we expect. This pandemic will go on at least through 2021 and perhaps well into 2022. So I think it's more analogous, not as fatal, but dynamically in terms of mutations, variants, strains, et cetera, probably more akin to the Spanish flu, which broke out in a big way in 1918, but it was still claiming victims in 1919 and even as late as 1920. So I think this may be with us for a couple more years. Vaccines, we're all hopeful, but there have been, the rate at which the vaccine was produced was miraculous, and governments have done a pretty good job. The pharmaceutical companies have done a pretty good job of creating the dosages, and governments have done a pretty good job of getting them to the injection places, the clinics where you would get the inoculation. But it falls down after that. Israel, UAE, and a few others have done a good job. The United States varies by state, but some places it's awful. It's just the public health system's a mess. New York is actually flushing dosages down the toilet. And the reason is that these vaccines have to be kept super frozen, like 100 degrees below 0 centigrade. And they can do that and deliver them to the point, but then you have to thaw them out or defrost them before they're injected. But at that point, it's like a quart of milk. The shelf life is less than 2 days or it goes bad. And so New York got them, defrosted them, and then couldn't administer them, couldn't inject them. And then at that point, they had to be disposed of. So when you hear people say, we don't have enough, it's because your system was so inefficient. The US gets tangled up, and the people who should get it are obvious, over 65 with comorbidities, asthma, diabetes, obesity, other illnesses, and frontline healthcare workers, so doctors, nurses, paramedics. That's obvious, but nothing's obvious in the United States anymore. Somebody decided that social justice should be the criteria. So they said, we need to give it to poor neighborhoods. So really healthy people in poor neighborhoods are getting it before really ill people in nursing homes, which makes no medical sense, but it is the kind of political logic that we are subject to. So number one, that's the first problem. The second problem is that the virus has shown a very kind of nimble ability to mutate. Now, that's not unusual. Viruses mutate all the time. But if there's some evidence that this actually was bioengineered in some ways in the Wuhan Institute of Virology in Wuhan to be more potent or more infectious, if you will. So some of the new strains or variants, particularly the so-called UK strain, English strain, and the South African strain, are showing that they're more contagious. Now, people say, well, it's more contagious, but the fatality rate isn't higher. That's very misleading, because the fatality rate may not be higher, but the number of fatalities is higher, because if you get more cases, you're going to get more fatalities. So I don't really care about the rate. I care about the number of people dying, and the number of people dying is going up. So right now in the United States, we see similar data worldwide. The number of new cases, or the caseload, today is 10 times greater than it was last March and April. Like everyone remembers March, the height of the lockdown, et cetera. The number of cases is 10 times greater. And the number of fatalities is more than double. So what we're seeing right now is much worse than what we saw last spring. That means that the governors are going back to lockdowns. And as I explained in my book, lockdowns don't work. The evidence is clear. There's plenty. I sort of went out on a limb a little bit with the best data I had last spring when I was writing the book in May and June, and reached the conclusion that lockdowns don't work. Well, they don't work to stop the spread of the virus. They do destroy economies. They're very good at that. And I made that point in my book. And I got a little pushback from some friends at my publisher that said, Jim, come on, this lockdown is very popular, et cetera. But since then, particularly in the last month, there's been a wave of hard empirical data showing conclusively that lockdowns do not work to stop the spread of the virus. Let me give you a concrete example. We always say the United States is like a big laboratory because we have 50 states. We never had a national lockdown. It was up to each governor and each mayor to decide what the lockdown rules were. So you had kind of 50 flavors. And, some places had an extreme lockdown, New York and California, for example. Other places had moderate lockdowns. And some places, South Dakota in particular, had no lockdown. The governor said, look, wash your hands, wear a mask, social distancing. But other than that, we're going to leave it to the citizens to decide what your comfort level is and how you want to act during this virus. The same thing globally. Korea had an extreme lockdown. Brazil had initially almost no lockdown. And Sweden was a middle case, a moderate lockdown, but not nearly as extreme. Well, anyway, we have the data from all the states and 30 major countries around the world. And what the data shows is that there is no correlation at all between the type of lockdown you selected and your caseload and fatalities. In other words, you could have a moderate lockdown, a no lockdown, or an extreme lockdown, and you got the same results in terms of caseload and fatalities, which any statistician or scientist would say, well, that means lockdowns don't have any effect on the spread of the virus, which is true. And this was, by the way, this isn't some fringe study. This was a team led by a professor of medicine at Stanford University and equally expert collaborators, and backed up now in something called the Great Barrington Declaration, which thousands of scientists around the world have subscribed to. It's an open letter, and you can kind of sign up online saying that lockdowns don't work. Now, why do we have lockdowns? Well, because governors are, I hate to use the word morons, but they kind of are. They don't know anything about medicine. They don't understand what I just explained. They don't understand the science. They claim to, but they don't. But they understand politics. And when you have a crisis, going back to what we said earlier about, Klaus Schwab, never let a good crisis go to waste, you have to do something. You can't be seen to be doing nothing. Sometimes doing nothing actually is the best approach, but you can't be seen to be doing that. So they impose lockdowns. So they appear to their citizens as decisive, but all they're doing, they're not stopping the spread of the virus. Look, if lockdowns work, why is the caseload 10 times greater than it was last spring? I mean, just ask yourself that question. Well, the answer is lockdowns don't work, but they do destroy economies. And people say, well, the stock market's had an all-time high. Well, it is, or close to it. But the S&P 500, which is most people's benchmark, is actually the S&P 7. There are 7 stocks, and we know what they are. It's Facebook, Google, Apple, Amazon, Netflix, Microsoft, and Tesla. Those 7 stocks are 40% of the market capitalization of the entire S&P 500. And it's a cap-weighted index. the ones I just named are the least affected by the pandemic. They're all digital, online, technological, streaming, entertainment, et cetera. They're not bricks and mortar, and they're not, as I say, affected by the pandemic. So you got 7 stocks leading the index higher. Most people are passive investors. So you get this recursive function where the price goes up, I buy more, the price goes up, I buy more, the price goes up, I buy more, and it keeps going because of passive investing index funds and ETFs. Okay, that's the stock market has never been more detached from the real economy. And what's going on in the real economy? Well, people look down their noses at small and medium-sized enterprises. They go, well, you know, the restaurant closed. They had 20 wait staff and bartenders. It's only 20 people. What's the big deal? They'll reopen in a few months, et cetera. No, in the aggregate, small and medium-sized businesses are 50% of all jobs in the U.S. economy and 45% of GDP. It's half the economy. And that's the part that's getting crushed. You cannot crush half the economy, which they're doing, and not expect a recession. So my forecast is we're in a recession right now, first quarter of 2021. We had a technical recession in the first half of 2020, first quarter down 5%, second quarter down 31%. Third quarter came back, fourth quarter, it's going to end up kind of, you know, up maybe 7%, give or take. But the total year, the full year, 2020 in the United States, the world's largest economy, is going to be down about 7%. That's never happened before in U.S. history. I mean, you're talking about $1.5 trillion of lost output relative to a 2019 baseline. We're not going to get back to 2019 until 2023 at the earliest. We're still digging our way out of the hole. However, my forecast is that we're in a second recession right now, the first back-to-back recession since 1980-81. And that's an easy forecast because you just locked down half the economy. So you should not expect any other result. That tends to be deflationary. I know my Austrian friends and my European friends and my collaborators here in the United States all look at the money supply and say, oh, this has to be inflationary. It's right around the corner. Here it comes, you know, et cetera. And I say no, because money supply has nothing to do with inflation. What the key explanatory variable for inflation is the velocity, it's the turnover of money. So U.S. money supply today is about $7 trillion. That's base money. That's up $7.5 trillion. That's up almost $4 trillion since this time last year. So $4 trillion of new money printing. But as I remind people, $7 trillion times zero is zero. Meaning if you don't have velocity, you don't have an economy. You can print all the money you want, but if people don't lend it and spend it, if they don't consume, then your velocity drops and your economy drops. And right now, people are not lending and spending. The banks are not lending, and individuals. So, you know, right now, the stock market's going up a little bit. Why? Because the Biden administration is coming in, and they're going to do another bailout law, and they're going to send everybody, pardon me, a $1,600 check on top of the, $1,400 check on top of the $600 check. So everybody in America, in effect, most people are getting $2,000 checks. So Wall Street, in their usual flawed way, are saying, well, everybody gets $2,000 checks, so they're going to run right out and buy a new refrigerator, a new car, recarpet the house, paint the roof, whatever. No, people are going to get the money. That much is true, but they're going to save it. And that's what they're doing. That shows up in the data. Savings rates are skyrocketing. And you either pay down debt, which is the same as savings economically, or you actually save. If you lost your job, you're certainly going to save. You're not treating your friends to dinner. But even if you didn't lose your job, odds are good that your spouse lost his job, or your neighbor lost his job, or you're worried that you might lose your job next week, or your business might fail next month. So this is what economists call precautionary savings, you know, plain English, save for a rainy day. But even if you have your job and the kind of life that goes on, you're going to put more money in the bank just in case. So that means velocity is dropping, and you can understand monetary policy and economic growth is a desperate struggle between increasing money supply and falling velocity. Velocity is falling like a rock. I actually, last night, I looked at the most recent M1 velocity chart from the Federal Reserve Bank of St. Louis. They're the Fred system, which, you know, is great source of data. and the impact of the 2020 pandemic. It's vertical. It's like a cliff dive because it goes like that. That's on top of a long-term trend of declining velocity. So I think deflation is the greater danger than inflation. The U.S. economy is in this recession right now. And we're not getting past the pandemic quickly, at least not this year, maybe early next year at the earliest. But all this is described in my book, including I have a whole chapter just on the mental health aspects of this, greatly underreported, not well understood. Suicide rates have tripled, murder rates have doubled, drug abuse is up, alcohol abuse is up, domestic abuse is up. It causes depression, anxiety, anger, and I would say there's some relationship between the mental health impacts of the virus and some of the behavior we've been seeing, particularly in the United States, with the riots all summer and the recent assault on Capitol Hill. Do these have political causes behind them? Well, they say so, whether it's left wing or right wing, but query whether some of it, maybe a lot of it, isn't the not pent-up demand, as they say, but pent-up anger and frustration, partly because of quarantines, lockdowns, and social isolation. So this is the first book that tackles both the medical and the economic aspect of this. Doctors are writing books on, clinicians are writing books on the pandemic. Economists will get around to writing books, although economists actually prefer articles to books. Not that many economists really write books because you have to go out on a limb a little bit. But this is the first book that combines both, takes the pandemic and the economy, shows the connections, and gives a forecast for what's coming in the year ahead.
Thanks, Jim. I would like to, because you have got another appointment in a couple of minutes. Willem, I would love you to talk a bit about your investment style. You've got a Discovery Fund that performed tremendously well last year. For you, a 10-bagger is something just normal. You really try to find those companies making world-class discoveries. So could you please elaborate on your way of investing, how you see volatility, where you are currently positioned when it comes to gold, silver, perhaps also the commodity space, topics like EVs and perhaps battery metals. Yeah, and if you want, of course, you can also put out some names that you like most, or like the biggest holdings in your fund. So would love to hear your way of investing money in that fund. What? You're on mute? Yes.
I received some messages, so I muted it. So if Jim has to leave, maybe he feel free to stay. But let me discuss my investment thesis. I was a private investor in Dutch real estate in the 90s. I started to take profit on real estate in the early 2000s because I was a little worried about a coming crisis. And I started to invest in gold and silver companies as a hedge on my net worth. And in 2004, 2005, there was a first correction. And all my holdings, I had 30 different holdings. They all went down 40, 50%, but 3 did much better. And then I started to do some serious due diligence. And then I learned that the 3 who were outperforming because they all 3 made a major discovery that year. They were producing already, were producers. And that made me change my mind as an investor. And I thought, if making a mineral discovery is such a value creator, then I should focus on that part of the mining space. And that's what I've done since 2005. I had a discovery investment letter tipping investors about new discoveries. But I stopped doing that because there was a banker who was a friend of mine. And he said, "You're stupid, you send out your best tips for $99. You should keep that tips close to yourself and build a fund around it." And that's how the Commodity Discovery Fund started in 2008. But I made a big mistake. I started at the top of the last commodity cycle. So for the last 12 years, we experienced a downturn. And in this downturn of 12 years, it was a brutal downturn, and many of our peers, they didn't survive. But we kept net inflows every year because I have quite a large retail following in the Netherlands, and they stuck with us. And during this long downturn, we had 4 years in which our gross return was over 70% a year, 70. So this clearly shows that the model works, and the outperformance compared to, let's say, the GDX is incredible. Gold was up last year 25%. GDX was up a good 27%. We were up 85%. And the difference can be explained because we only invest in small companies responsible for large discoveries. I know you're on the board of Tudor Jones. You know the wealth creating effect of a
Tudor Gold, not Tudor Jones.
Oh, sorry, Tudor Gold. Tudor Jones was mentioned earlier. So if you concentrate as an investor, and we are lucky that we're still a small fund. We crossed the $100 million mark in December, but we're still a small fund. And small is beautiful in this space because the best returns are realized when you can invest in a junior mining company, which is still not followed by many investors, which still has a market valuation of only 10, 20, maybe 30 million. And when they publish their results of a discovery hole, showing that they are on the verge of finding a new world-class discovery, the value of these companies, they rise within 12 to 18 months from 20, 30 million towards 1 billion. And this happened to the gray mining last year. This happened to Greatland Gold last year. So these are two great examples of 10 baggers in our portfolio. They're number one and number two in our portfolio because we are like a opportunistic commodity hedge fund. We can scale up our positions very rapidly. We don't have a large management structure. So I'm the fund manager. I'm doing the hunting. I'm looking for the new discoveries. And when I feel that we found a new discovery, yesterday we had a new situation. I can't mention the name, but we bought over $300,000 of shares, within 24 hours. Because the first indications, the first press release is so intriguing. Mineralization over 900 meters. Copper mineralization over 900 meters. We don't have a stage yet. And then we go in very quickly. And we're a UCITS fund. We're allowed to build one position up towards 7.5 or maximum 10% of our fund. We need to stop buying when a position is over 5% of our fund. But you have these rapid gains. And we learned not to sell. When you have a world-class discovery, you don't sell. You buy the dips. It's like the best bull market ever. You buy the dips. You buy every dip. And of course, as institutional investors, we can use the private placements in which you can buy the shares on a discount, in which you get the free warrants. Mm-hmm. So this is an amazing opportunity from an investor point of view. And I've been studying finance for at least half of my life. I've been looking for the best business ideas. And being a discovery investor in a fund where you can also have the performance fee model is the best discovery I ever made. and I'm always very honest about it. I always tell my investors, I want to make money and I want to have part of your profits, but I only will take part of your profits if we make more than 6% a year. And if you make 80% a year, nobody blames you for taking part of the profits. And I love this. I live for it. I've never worked so hard in my life. I work for 12, 14 hours a day, hunting for the next discovery. You need to work hard. You need to study a lot, but I love it. And I always call it's like fishing for older guys, for boomers.
And you also like we do it. You also have your personal money invested in the fund that you're managing, right?
Yeah, sure.
So you've got skin in the game. Okay.
I think 70-80% of my net worth is connected to the fund through all the investments. And I would never, I can never understand why somebody would run a fund and not be invested himself or not be interested himself. You want to build a fund. You've done it yourself with your digital assets. That's a great idea. You want to build a fund because that's the best idea you have. And we have had all kind of people coming over to us because we have all the permits now, and they want to start a crypto fund. And I looked at all the ideas, but I like crypto, and I like the upside there for a fund from a fund perspective. But it's not better than our discovery investing model. I want to keep doing this. It's like Warren Buffett or Soros. I want to still be doing this when I'm 80 years old. I love it.
Excellent. That's a great way to end our conversation. Thank you very much, Willem. Thank you very much, Jim. I hope you all enjoyed this. Have a look at the new book of Jim and, of course, The Big Reset. We look forward to the next advisory board discussion for the second quarter. Of course, I think it's going to be a interesting ride over the next couple of years. We've got the inauguration today and lots of things happening. Most importantly, be good, stay healthy, and we all look forward to seeing you soon again. Thank you very much.
Thanks.